now have the pleasure of welcoming Stuart Boucher, CFO of Decibel Cannabis. Decibel had very early on built a reputation in premium dried flower with its Qwest brand. It has proven to be very adaptable to market conditions, launching its value-oriented general emission brand product line and quickly becoming a leading supplier of extract and derivative product formats once Cannabis 2.0 product formats were legalized across the country. This includes leading market positions in vapes and infused pre-rolls today. Profitability was also a very early focus for the company, and with its most recent quarterly results, Decibel notched its 11th consecutive quarter of positive adjusted EBITDA. With that, I'd like to turn the call over to Stu for him to discuss Decibel and more about why the company has been so successful in such a challenging market. And with that, Stu, please go ahead.
So appreciate being here today. Just getting into who Decibel is. We're a leading cannabis company within the Canadian market. We pride ourselves on a few very specific things. So innovation, R&D, quality, consistency, many of those things that we believe over time build brand equity and consumer loyalty, which, we're in the early innings of. And we think that's the most important factor ultimately to building success within this marketplace. We think we've achieved early indications of that, and are very proud certainly to be one of the strong players within the Canadian marketplace who's now starting to take those brands into the international landscape. We've been able to do all of that in a profitable manner, as you mentioned, with certainly a tremendous amount of financial discipline. So getting into, Getting into Decibel at a glance, we have broad distribution across Canada, certainly some additional opportunity for distribution. So on the left-hand side, you can see all the green markets are where we are in today. And that's across two specific brands. So General Admission, which is kind of your core catering product offering to your average consumer, and then Qwest, which competes in the more premium segment. That's supported through three different facilities, one being our manufacturing facility here in Alberta, and then two cultivation facilities across BC and Saskatchewan. When we look at a few other details, it really starts with our product portfolio. We've focused on what we would coin ready to consume, which is products that are easy, kind of cater to the North American culture of ready and on the go, and allow for a lot of trial within group settings and through friends. That's led us to be top 3 in market share. So as recent as Q1, 6.7%, again, placing us 3rd. And that market share represents true profit behind it with strong EBITDA, 11 straight quarters, as well as early stages of adjusted net income generation, which just excludes biological asset impacts. So when we get into our highlights, we think we're driving success in Canada in a large way. We've created a strong history of execution and continue to see, a very exciting outlook ahead. With our most recent quarter, we had record level revenue and strong profitability despite seasonal headwinds that everyone seemed to encounter. And that's all supported through this model that we've developed. We're taking that model now internationally, where we believe we've built substantial brand reputation in Canada, and it supports establishing a platform for international growth. So we're targeting new markets in which we can operate in the same effective way, attract customers, and ultimately build brand loyalty in a market that is going through tremendous tailwinds of growth through legalization in a similar fashion to Canada. That started off with an asset-light expansion, starting with Israel in the 4th quarter, and certainly new markets to come during this year. Just a quick snapshot, we're well positioned to go and execute on both Canada and international with cash flow, access to debt capital, an accordion, and a low leverage profile that positions us very well in what is a very challenging market at the moment. And all of that, where we try to get as much of this story out there, we believe that we trade at a significant discount despite our profitability and certainly the trend and history of execution that we've built. And so certainly encourage everyone to do their own work and look further at the story. When we look at our track record, all of the short-term targets on the left-hand side are things that we've communicated in the past year to year and a half. And we've executed on all of them. So we've seen strong market share growth, stepping into Israel, good revenue, profitability on a number of important metrics, and a strong leverage profile. And as we look towards the future, we see that trend continuing with ample amounts of growth ahead. So within the Canadian market, we believe we can go out and grow our revenue to roughly 200 million. That's over the next few years, in which we see additional distribution coming online. We have a highly concentrated brand portfolio, so introducing new brands that either target different price segments or different types of consumers, and then taking our existing brands into new categories as we see good traction when we introduce new products for brands that already have consumer loyalty. Over time, we equally see that international will become at the forefront of our revenue generation. And so we're positioning adequately for that right now, where we want to be early movers in those markets. So over time, we want to be one of the globally recognized Canadian leaders that in turn supports brand recognition on a global scale, all while doing that in a profitable manner. So we feel very comfortable with the margin opportunities we have ahead of us through investment, that we can maintain our profitability and grow it substantially, and at the same time continue to target a very advantageous position from a leverage perspective that gives us a bunch of flexibility. So getting into our portfolio, as I touched on previously, we really believe that cannabis products are trending towards easy, on-the-go, simple-to-consume products that consist of pre-rolls, vapes, edibles, beverages, and which you've seen over the past 2 years grow substantially to now where it represents more than 50% of the total market. On the right-hand side, you can see how we've positioned our portfolio. So we've invested heavily in growing our margins, having the capabilities and quality and consistency to deliver on this product set. And that's led to us having #1 positions in both vape and pre-rolls, with some of those other categories soon to be entered by either our existing brands or new brands. That has in turn led to us having strong market share growth, participating in that theme I mentioned, but at the same time, really striving for other areas in which we can compete effectively. So the green line represents Decibel's market share growth over the last 2 years, to which we've more than doubled our market share. And that's placed us in the 3rd position, just behind Village Farms at 6.7%. I'm excited to say that that trend's continued past Q1, with as recent as May results putting us at 7.4%, with a lot of catalysts to come over the remainder of this year. And so why we think it's so important that we have that position in Canada that places us in the top few and continue to entrench ourselves is really a belief that Canada is overlooked, but it's a really critical market to be successful in. We think it's the cornerstone ultimately to growing globally. Not only is it just attractive in its own right, it's the 2nd largest market behind California. It has a great opportunity for growth and certainly outpacing the economy over the next decade or two. But it also has very attractive margins for where we sit today with no regulatory changes. Where it becomes really exciting is its capability for export. So there's very limited jurisdictions to which we can export for new legal markets that are coming online that are going to experience very similar nuances to the Canadian and US market, in which early on, quality is a challenge, and growing it at scale and being able to deliver on that is far more difficult. So having that export capability to build an early mover position early on in new markets as they legalize, and being able to replicate, again, what we've built in Canada with quality, consistency, and a consumer-focused approach, we believe is a recipe for success in terms of creating market share and then benefiting from decades-long growth in this market. And so overall, just to summarize, we believe that Canada is really where you can find a pathway to build global brands over time. So getting into our international expansion, it's very early stage, but the opportunity is certainly endless. We've entered Israel, and that was as recent as Q4. We've had ongoing shipments and good success with our brands there. Certainly see additional opportunity for innovation, new products, and new brands entering that market, but overall see a broader opportunity of targeting the EU and other countries that present, again, long-term growth. Certainly the market isn't 200 billion today, and likely with most projections, it's not going to be anywhere near that for a while, but the opportunity is so substantial compared to the Canadian market. If we can build that early mover advantage with the same Canadian model that we've built today, it's going to provide ample amount of opportunity for double-digit growth through Decibel for a very long period of time. Getting into our financial performance to date, we've had another record year, roughly 80 million of net revenues, 17 million of EBITDA, which was about a 21% EBITDA margin. And on a quarterly basis, we're continuing to see a very strong trend. So as recent as our Q1 results, we're already showing annualized sales of north of 100 million and EBITDA close to 30 million. We're, again, very confident given our market share growth heading into Q2 and our initiatives over the rest of this year that we'll continue this trend of sequential growth with very high double-digit year-over-year performance as well. And then getting into our balance sheet and how we're kind of navigating the current market to date, it's a bit different. So certainly it's a bleak sentiment around. There's limited access to capital. There's very few profitable companies within the landscape, and it's highly fragmented. And so cash flow ultimately is king in this environment. And we're continuing very, very strong financial discipline. We believe that it's going to present two different opportunities. One, whereas companies restructure or ultimately try to protect their balance sheet, they're cutting competitive spend. So whether that's marketing, sales, distribution, ultimately those are things that will be well positioned to go out and spend further on to go and take further market share. Or equally, we could see further CCAAs or cheap assets for sale, in which the few are going to have an opportunity to pick through and find other brands or assets that help accelerate their business. So through that, we're focused on two primary things. Operating cash conversion, so that's our ability to convert into cash flow from EBITDA. Last year, we were roughly 50%. We're continuing to target 50%. The remainder is getting reinvested in the growth, our new products, our international expansion, but we believe positions us well to react and be very flexible to an environment where there's an abundance of opportunity. And then equally, we're focusing on leverage. So as of our recent quarter, we were 2x debt to EBITDA on a trailing 12-month basis. Annualized, we were 1.6 times. So that gives us an ample amount of dry powder through additional leverage or through our existing accordion that's undrawn to, again, focus on those areas as they come up, whether it be new markets, new products, competitive spend, or M&A opportunities, albeit we're very focused on organic growth first and not disrupting our existing business, which is why you haven't seen any transactions from us today. Looking at our debt capital, it's extremely attractive and has been a very strong partnership that we've had in place. 86% of our debt is fixed interest rate, so 4.75%. Very attractive, has insulated us largely from a rising interest rate environment, and still has substantial headway. So it doesn't come due until 2027. We believe we have a very strong partner and have no concerns over refinancing. And we have an existing line of $7.5 million that is on standby and ready to draw at any point for any opportunity where we see a good return on capital. So we think that helps us navigate in terms of capital markets today. We think that market share is the most important factor. That ultimately over time will dictate winners and losers, like any other CPG industry, and allows for creating profitability, expanding margins, reinvestment. And so we look at that as a proxy of who's winning and who's losing. And so within this competitive set, we look at EV market share, which is, a non-traditional metric, but we think is a good indicator of value, at least at face value. And then you have to drill down into the actual financial results, to which you'd find Decibel is one of the few who's actually generating a profit from their market share, at least within the top 10 players within the space, which you can see on the bottom half, where we're the only one who's generating adjusted net income, which again is just normalizing for biological asset impacts, no other adjustments. What I think is most telling is our financial discipline when you look at share capital, which is the third line of the table. We've raised less than 1/10 of most of our peers. And so we've found a way to maximize the return that we get for every dollar invested and do it in a very lean manner to still position us as third largest in the industry. So we're very proud of that. We think that this is going to continue to be something to be very fixated on. And profitability is really going to drive the success over the next 2 years as this industry goes through consolidation. Getting into how we see it going over time. So certainly cannabis trades at a very substantial discount to many other industries. And that is probably warranted given limited profitability, limited history of results, and the market being very nascent, and much of the regulatory changes that are taking place. That being said, we see over time, as this industry matures and you see profitability, consistency, proper communication and execution against that, all of those things happening, we think over time, creates opportunity for multiple expansion and to either trend in line with many of these other industries or potentially at a premium given cannabis's long-term growth that is likely to outpace the economy on a global scale. We think Decibel is well positioned and at the forefront of that, given our best-in-class margins, the profitability that we've had to date, and the track record that we've built to benefit from that margin expansion. And so we think that is a good opportunity to highlight the story and why we trade at such a substantial discount to what we believe is our intrinsic value, where we're not as fixated on day-to-day movements in our share price, but more so focused on building fundamental value through our business with the expectation that over time, the cannabis sector will revert back to norm or potentially trade at a premium to many of these other groups. So just wrapping it up, we're very strong believers in driving fundamental value and that leading to share price appreciation over time. We've done that through creating a very dominant Canadian position and ultimately a platform that allows for high double-digit growth over the medium to long term through international expansion. We've positioned ourselves with best-in-class margins to benefit from both of those segments of our business growing over time, and believe that there's ample opportunity that is undiscovered as of yet that will continue to add to our business. We have proven execution where we've achieved and certainly are on track with all of our company targets that we've communicated publicly, and that we are going to continue to do so in a very capital light manner where we protect our shareholders and we focus on driving value without raising capital through equity markets. And then again, just reinforcing, we believe that we trade at a substantial discount ultimately to our peers and to our intrinsic value. And so would like to encourage in-market buying and certainly taking a harder look at Decibel.
Great. If you're done there, Stu, thank you very much for the presentation. We really appreciate that. So happy to move into the Q&A session. As a reminder, the audience is welcome to submit questions through the chats, or else you can email me directly. But I'll kick us off here with the first one. So I want to start off by asking you, Stu, about Decibel's history and really pioneering the infused pre-roll market in Canada. Obviously, that's been a huge tailwind to your success and momentum over the past several quarters. How did it come about where you were willing to make such a big investment in a single product category? And do you see the potential to do this going forward in new product formats as they emerge? Is your model and your setup flexible today to be able to capitalize on changing industry trends?
Yeah, so how we really found that opportunity is through very aggressive consumer insights. And we're constantly scouring consumer data, not only through R&D at our own facility, consumer focus groups, as well as looking at other emerging markets, where infused really was starting to come to the forefront within the US. Again, we invest heavily within those products in kind of the early trial period to make sure that they're really hitting the mark for the customer and we're delivering a good value proposition. But we actually are very capital light at the front end of any sort of new product launch. So we try to de-risk it as much as possible. Again, trying to be very lean and disciplined, where everything starts off manual. And that's where you see our margins over the past 4 to 5 quarters certainly expand dramatically, because we start with limited investment in equipment, manual processes, and then we create a list of investment opportunities over time where it's sized appropriately to the scale and demand that we see in market. And so we have much better clarity over return on capital, over managing our costs, and so on. We do believe that there's further opportunity for innovation within this space. It's going to get harder over time, and not everything's going to be as easy as launching our infused pre-rolls, but we'll have another product coming out shortly that we think hits the mark in that regard. And we're continuing to do so. And very much our portfolio development consists of focusing on kind of down the fairway opportunities that we think are low-hanging fruit, cater to customer needs, and then also dedicate a portion of our time and resources towards what we'd consider asymmetrical return products, where they may be a bit fringe or unique or new to the market, but create far more upside if it does end up resonating with customers.
That's very helpful for understanding the strategy. Appreciate that. I want to touch on another thing you brought up in those remarks, which was the ability to look at customer data quickly and do a lot of research on the front end before deciding to invest in a product category. To that point, one of the unique aspects of Decibel is it does have a handful of stores, and it was one of the very few LPs that does own a small retail network. How does that inform your ability to get a sense of what the consumer is doing in a timely manner? And how does that feed into your product innovation?
It was very helpful early on, and I'd say it contributed largely to our success on the product development side. And so you'd always see other retailers saying, "Well, are you guys trying to compete with us? And does it get in the way of, our partnerships that we have?" And the response is always no. We're not investing or trying to grow those stores in any way, but what they do in turn is help provide a better experience for retailers, customers, and the rest of our partners. They inform a lot. They allowed us to be very nimble, see consumer trends very early on, and tap a large network of customers to understand, what future products they'd want to see. So we had a 25,000 customer email list. We could use that to understand new products that customers want that don't exist today, and then take that into the R&D stage. And equally, it provided a R&D training ground where we could sell in a legal manner and compliant with Health Canada early stage products into those stores, get consumer feedback, and make tweaks to our products so that when we launch them on a national scale, they're far more successful. Now we have an R&D license, and certainly that fills in a lot of that work that otherwise would have taken place on our retail stores. But we still find them very helpful in informing and building a stronger relationship with consumers in general.
That's great. I want to switch gears and maybe talk about the international market opportunity, which you alluded to as part of your growth plans. How does the momentum and your experience in the Canadian market prepare you to compete on an international scope? What do you think is the most important aspect of your strategy for winning overseas?
Yeah, I think the most important aspect is as simple as it may sound, is maintaining a commitment to quality, consistency, and a reasonable price. When you look towards international markets today, pricing is, certainly elevated compared to Canada. And you see people approach the market in different ways, where some may view it as an opportunity to offload less quality product given the level of competition in Canada as of today. We actually view it the opposite. Canada represents 5 billion as of today of total market opportunity, and certainly international is going to represent 10x or more than what Canada is. And so just having the discipline to make sure we're getting good product to that market. We're not trying to take advantage of the pricing that we're seeing today, but we're thinking about the pricing of tomorrow. And we're trying to have the consumer in mind at every given step. I think is really critical early on, because it's been proven if you make the consumer feel like they've been ripped off in any sort of way, or don't deliver on your promises, there's another 10 brands in line behind you to go in and take that consumer and keep them as a long-term customer.
That's great. Maybe a final question would just be on your M&A and the potential to do that in the market. You said over the past few months you haven't been so active there, as you've been heads down focused organically, but you've also alluded to a higher number of opportunities coming to market. What would be the best fit for Decibel when you think about M&A opportunities and the ability to consolidate maybe just struggling or distressed operators, but which do have some parts of the business that are valuable? How do you see that playing out over the next few quarters or over the next few years?
Yeah, we take a longer term view on the value that you can get from M&A and how we see this market unfolding. Ultimately, we think it's still a race to the top. I always like to be a historian in these situations and look towards the alcohol market as a proxy, and what makes the large incumbents insulated from fragmentation and from new entrants coming into the space. And what it boils down to is size and scale that affords the majority of your spend going towards competitive activities like sales, marketing, and distribution. That's really what what economies of scale would represent as being an insulating factor. And so we believe that we need to go through tremendous growth over the next 5 to 10 years to position Decibel as one of those large incumbents, not only in Canada, but in international markets. And we think we have an organic growth strategy that gets us there on our own. Where M&A comes into the fold is accelerating that strategy, or allowing us to do something that otherwise has risk associated with it. And so when we sit here today and we look at an abundance of opportunities that are available and up for sale, we focus on a few key things. Is there a competitive advantage to the business? Is it a distraction from our existing organic growth strategy? And is it going to take away from us being able to execute on it? And so effectively, is it a turnaround, or is it a business where our resources can help scale it faster, quicker, or reinforce it in some manner? And so certainly we want to keep our eyes peeled, look for those opportunities. We do think some exist in the market today, but then it's just a matter of timing and when it's appropriate, and certainly letting other companies go through that period of maturation that we all are going through. So we're not urgent. We're trying to be disciplined and patient, and recognize that much of the M&A that's taken place to date has been value destructive, and so we need to be extremely thoughtful in our approach.
That's wonderful, and thank you very much, Stu, for all your insights on that question and throughout your presentation. Decibel is clearly doing very well in the market, and you've got some great momentum behind you. And thank you for joining our event.